Cypress Development Corp. is developing a world-class lithium resource in the heart of Clayton Valley, Nevada. The size of the resource makes the Clayton Valley project a premier asset with the potential to impact the future of lithium supply. Cypress Development Corp. trades on the TSX Venture Exchange, symbol CYP, the OTCQB, symbol CYDVF, and on Frankfurt, symbol C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Danielle Park, editor of the popular blog Juggling Dynamite and president of Venable Park Investment Council Incorporated. Welcome back to the show, Danielle.
Thanks, Jim.
Danielle, an article in your latest blog says, look out for a stock market crash. Is that what we're seeing today with the Dow down 1,400 points, the NASDAQ down 360, the S&P losing nearly 5% of its value, Toronto plunging over 540 points? Are we witnessing what you just wrote about?
Well, I wrote that actually yesterday, before today's deluge, but no, it's really, I mean, and again, points-wise is a bit misleading these days because for example, the Dow got so high, 25,000, so 500 points, doesn't sound, it isn't in percentage terms as bad as it used to be, so to speak, Jim, but yes, when you look at in percentage terms, today's the worst day since March, for sure. Most things down over 5%. But the reason that it was so obvious that we were looking for the next leg down, and I don't think it's a one-day event. I think it's a multi-month event that we should expect to see pressure to the downside. And I think the reason is that, into the March 23rd bottom, when we had the fastest 37% decline in history, you then had, central banks of the world throwing everything they had at it, fiscal policy, governments throwing every, dollars in cash at every household and every business. And there was this sort of a quick rebound, between, March and, into June of, speculative frenzy, frankly. So you have this, millions and millions of people literally at home, off work, locked in their homes, supposed to stay in, right? And you've got them with a computer and some free money and a gambling mentality. So what you've seen is that liquidity, they weren't able to go out and consume much or spend much. So what they did is they doubled down on trying to win some money and calling that a sort of a day job. It was like day trading became the latest frenzy again. And this isn't my first rodeo, Jim. I don't think it's yours. I think maybe you remember for example, the tech bubble in 2000 that there was this same kind of obsession with gambling, .com stocks, anything with a .com on it was considered a hot potato, and everyone was, trying to get rich by buying things without doing any work, without doing any analysis, without doing any probability or any, actual valuation or, prospects of business viability. None of that was relevant. It was all just buy what you thought might go up. And so people got overly complacent when they did buy things and they went up, they thought they were geniuses, right? So they were encouraged to wager even more and borrow money to wager more and in fact go into things like options, which are highly levered. Well, we've seen the same thing here where you can get exposure to a move in a stock by buying an option rather than having to fork over the full price of the share. So you're putting out less and you're getting the movement. Now it works both ways, of course. You can have a big gain if you hit it, luckily, and you can have a massive loss when it goes the other way. And that's exactly what we're seeing. So, for just a classic example of the tenor of the times, Jim, is companies like Hertz Rental Car, which declared bankruptcy, from $20 a share back in February. That stock went to 40 cents a share by May 26th. And it, declared that it was entering bankruptcy proceedings. And that's when you saw the online trading crew go wild and bid the price of that bankrupt company up to $5.53 a share by June 8th. So in the last 2 days, the prices once again dropped 61%. And this is absolutely, just the madness of crowds piling in. we've seen this explosion in the number of online trading accounts through companies like Robinhood and all these other, Schwab. And so again, this is something we also saw in the speculative mania of the 2007 peak, when we had a lot of, when China was, the fastest growing economy in the world, and you had everyone believing, that China could do no wrong. In fact, the economy had already turned down there, and Chinese people were resorting to wildly speculative gambling, and you had a rush of new accounts being opened. And of course, the sign of that is always more like a top than anything to do with a bottom. By the same token, we have the highest valuations we've seen in many, many years, and we've gotten so much worse since if you think about it, we've had this collapse in global GDP, and we've had this revaluing in assets, which has made them spectacularly overpriced once more. And this goes for junk debt. The lowest probability, quote, investment instruments have been bid up the most. So it's really this toxic soup of frenzy, desperation, gambling, and all of that is indicia of a top. It's not anything to do with, a bottom. I've said this before, when it's time to buy, when investment values are the greatest, when they're the most attractive in many years, the public tends to be nowhere to be found, right? They've already been crushed. They didn't have much savings to wager in the first place, and now they're just left with debt and leverage and margin and holes in their balance sheet left and right. And I'm afraid that that's exactly what's happening again, because people don't learn, I guess. They don't learn from the experience. Some do, and they change their behaviors, and they put in place policies to protect against the frenzied mentality, psychology that comes in at these different points in the market cycle. But most don't. They don't learn, and they just replicate the same habits each cycle with the very similar results.
We'll have more with Danielle Park right after this.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon, trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
Welcome back. We're speaking with Danielle Park. Danielle, the U.S. Fed says it's going to continue its emergency pumping in of stimulus for some time to come. Is that going to make any difference to the recovery of the economy, or is this to sustain the illusion that a healthy stock market is a healthy economy?
Well, it's the emperor has no clothes. He's been stark naked for quite some time, but the Fed just keeps promising to backstop, promising to bail out, promising to save people from their deserved losses. The reality of it is, though, that they have a fraction of the capital available to them. That is, like, for example, the recent support package that was announced to buy. They said they were going to buy corporate debt, junk bonds, and there was an amount of money authorized, $25 billion by the U.S. Congress for them to do this, buying of this debt. But the reality is that even if they levered that 10-to-1, which would be reckless, maniac stuff, and frankly, buying that debt is actually illegal under their constitution and under various regulations. So even if they were to do it, though, illegally and lever it up 10-to-1, the funds that they have available would be less than 1% of the market cap of the entire U.S. stock market today. So their actual ability to move price is very little. Their ability to move sentiment is significant because people have this belief in, the omnipotent powers. But it's actually a false belief. It's not actually something that they can follow through on. Clearly, we've seen this in the last 20 years. This is the third time we've had this kind of, wild, blind faith in magic tricks. And certainly it gives this knee-jerk where you get liquidity flowing again and people go back to the same speculative behavior and bid assets back up into the stratosphere, which makes no investment sense. What they really need to do at some point is get out of the business of fixing interest rates. And I think that ultimately, I don't think that they're ever going to choose that prudent path because no one has the courage to do it. And Jay Powell is a private equity man. He made his fortune in private equity companies, in junk debt, in all the assets that he's now trying to help his cronies and, help backstop and prop up the prices of this stuff. But what he's really done is have the market itself, without the Fed having to buy it, just by stating that they were going to do that, he's had he restored confidence for a while. So you had these speculative people go back in and start issuing debt, and investors were willing to buy it again on this false presumption that the central bank somehow could control and protect them from any losses. And so if you think about that again, with the collapse in the economy, you've had this, the OECD came out yesterday with a report that said, here's the trajectory of the economy. Even if we don't get a second phase of virus, here we are through to 2022. We are far below the path of economic growth that was expected or hoped for in 2019. And if we get a second wave, then it's even worse, right, looking forward. So this is something that the recession began in February. That's already been declared. Many people hoping it's going to be a quick bounce back. While no doubt there could be, a softening of the negative data, because at some point if you're reopening things, it's not going to look as bad as when everything was fundamentally shut down. But it doesn't mean that you've recovered in any shape or sense of the word. So you've got revenues under massive pressure. Sales and revenues of companies halving. And then you have a bunch of companies looking for ways to cut costs in that environment, to reduce their investment, to reduce their workforce. And the reality is that it takes many, many years to grow back the jobs that are lost. A very important part of this is that you have the service sector making up about 80% of North American jobs today, Jim. So, that was the very sector who benefited the most coming out of the 2007 to 9 recession. Service was an area that, tourism and travel and restaurants, that's where the bulk of the new jobs were created. They were low-paying jobs, but with manufacturing in a massive global slump, jobs being offshored, that commodities in a massive bear market, that was really where there could be some discretionary spending revived. People could borrow and go on with more consumption. Well, what you're finding is that the service sector is now that the portion of the jobs which have been clobbered, right, in this downturn. And they are the ones that are going to be slowest to recover. And that's a major problem for households, for spending, which still drives, anywhere between 60 and 70% of the North American economy is this consumption by households, which have been devastated. As I think I've mentioned before, even with the income replacement programs, on average, households are missing about 20% of their pre-COVID income. So even with these massive interventions and help, most people are missing a big chunk of their ability to spend. And not only that, they're in shock. The rational ones are trying to increase savings, which we've seen the savings rate has leapt. So whenever they're being given any sort of extra money, the ones that aren't just gambling and speculating because they're going for broke, literally, the ones that aren't doing that are trying to be more prudent and build up some seed corn because they appreciate how vulnerable they are in this environment. And so this, between saving and speculating, there's not much funds going towards spending here. And we have the Canadian economy now trying to reopen. In Ontario, for example, as of tomorrow, Friday, you're allowed to get a haircut again. We've got some restaurants reopening, patios and things. But the fact is that not very many people are feeling comfortable either financially or just socially or health-wise to go out and take that kind of risk? Why would you, if you can get takeout from a restaurant and bring it home, that's one thing, but why would you need to go and sit in a restaurant or sit on a patio if you don't need to? So I think a lot of people will choose not to go back to their old consumption habits. And some of that is very prudent because they were spending too much before and they don't want to add more debt in this environment, or they're not able to. Banks are certainly pulling in their lending. One of the bad things about the press conference yesterday with Powell was he mentioned how they were going to, in his view, not raise rates for years, essentially. Well, this is no news to anyone that's been following it because they didn't raise rates for years in the last downturn, and this one is significantly worse. So because they have no actual plan, they have nothing else except for false promises and head fakes. And at some point, the people that are going to buy that message have already bought. And the rest of the people that haven't lost their mind are saying, you guys are full of baloney. You literally just keep doing the same nonsense. Add more debt and stir. And it has decimated the economy. It has decimated our resilience for bouncing back. It is hammering the banks. The banks are down heavily again today. They should not have been bought up in the last couple of months in the first place because the prospects of their profits are massively under pressure here, Jim. We've got this, the yield curve was re-steepening for a little bit there, but now it's basically flat again. The government bond market, as the stock market roared in the last couple of months, government bonds, treasury yields didn't participate. They largely remained flat, which was a vote from the more sober part of the bond market to say, you guys are dreaming. You're not going to create inflation in this environment. Everywhere we look, we see deflationary pressures, stagflation coming, and you can pump as much liquidity as you want, but people are not going to go back to hiring or spending the way they were before this recession for many, many years probably. And so all of this is really just the reality, the backdrop. And that's even, as I say, even if we don't get another resurgence of virus. But unfortunately, if you've noticed, not surprisingly, in many places, you are seeing a tick up, in the Carolinas and Texas and Florida, places where they didn't take the mask issue and the social distancing particularly seriously. They're now seeing a significant jump in the spread. And so I think to the extent that we are trying to reopen, we should expect more cases of the illness, and I think that will be reinforcing and making people more cautious and afraid again of going back to old habits.
We'll have more with Danielle Park right after this.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlan, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Danielle Park. Danielle, with another market downturn here and an economic crisis that's probably going to take a few years to get over, are there opportunities there that people should be looking at?
Well, I think, we are quite optimistic that we are going to get a opportunity for purchasing some of these assets at much lower valuations and prices sometime in the next year potentially, could be even by this fall. It's very difficult to know how quickly this thing will unravel, so to speak. But in fits and starts, and I've been clear about that, we should expect fits and starts. We should see a multi-leg process. So the first leg down was into the March 23rd low. Then we saw a massive rebound, but exactly like we saw, for example, in 1929, in 2000, in 2008, after things have been so speculative and so overvalued and so disconnected from the consumer comfort, from consumer sentiment, all these things, once you get into the downturn period, stocks tend to flail around like crazy, as does junk debt. So that part of the repricing process is a multi-leg event. So the first leg down, a big recovery, which we've seen. It's been textbook. My partner Corey is a technician, and we're looking over his charts, and it's like, wow, this is textbook in terms of this first bounce, this euphoric, rebound. And then you get the second leg down typically, and you may get actually another rebound period at the end of this second leg down, but ultimately the final low comes typically after a period of many months. We saw this in all the last downturns, and by then, the day trading crowd has been emaciated, wiped out. They're nowhere to be found. Mom and pop is not interested in buying because they've been hammered all throughout this. What you want to do is maintain your liquidity and your sense of what it is you're interested in buying and in what percentage in your savings. But if you don't do that work in advance, then you're just whipsawed like the rest. You're hammered on the downside. You lose all your mental strength and emotional ability and financial liquidity to go in and buy these things. So the navigating through this means that you have to be countercyclical. You have to be ahead of the pack. You can't allow every false headline and news from central banks promising more of what they've been doing for 20 years to sucker you back in until things come into your value zone. And that's a function of having rules. But if you do have those and you do the discipline, the opportunity coming here is likely to be the best we've seen certainly since 2009 and potentially even more because things have got that much worse. Leverage is that much higher. People are that much weaker in terms of their ability to ride out a recession. Companies are a lot weaker than they were going into the 2008 recession. And so I think the opportunity here will be enormous for people that have cash when everyone else is trying to sell. That's an encouraging thing. But again, it's something if you don't plan, if you're not proactive, you won't be prepared or able to execute when you need to. And that will set people back for many years because the fact of it is that the top we saw in the early part of 2020 very likely will not return for several years, if even a decade is possible. It could be that long before you see prices continue or get back to that kind of level. In the 20s, it was 25 years, Jim, after the peak of 29 before stocks recovered. I don't know if it'll be 25 years this time, but I'm telling you, we have all the makings of the end of a secular bear. This is the third cyclical bear within the secular bear that began in 2000 from insane valuations, and we are today at just above those same insane valuations. So we should expect to have a decade or more of mean reversion process. Now, it could happen very quickly. We could have a couple of legs down into the fall, potentially over the next 12 months, and those who buy near that low could potentially have, outstanding returns for the decade that follows. Those that don't have that strategy, who just hold and hope and lose all the way down, are going to be many years digging themselves out of this hole. And most of them, frankly, don't have the time or the patience to ride that out, or the funds, right? So they'll be forced to sell things at inopportune times. So it is a hell of a mess. It's been created during, at the worst possible time for the baby boomers who came into this with too much risk and not enough cash, and too much real estate and not enough, income. But anyone who can understand what's happening and prepare in advance, this is going to be an incredible opportunity.
Danielle, thank you so much for chatting with us.
Hey, thank you, Jim.
My guest has been Danielle Park, editor of the popular blog Juggling Dynamite. If you have any questions for Danielle or any of our other guests, you can send them to info@howstreet.com. Our YouTube channel is Talk Digital Network. Find us on Twitter @HowStreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.